Welcome again, everybody. My name is Mitchell Zaddo. I'm the Managing Principal at Sharrock, Pitman Legal, and thank you very much for joining us for our webinar today on the upcoming commercial and industrial property tax. Joined by Andrea and Shubha, who I'll introduce properly shortly. But before we begin, we would like to acknowledge the Wurundjeri people of the Kulin Nation as the traditional owners of the land on which our office is located, and we pay our respects to their elders past, present and emerging, and we extend this respect to all First Nations communities throughout Victoria and wherever you may be logging in from. So I know many of you have attended our webinars before, so welcome back. And if it's your first time, then a very warm welcome, especially to you. And it is a busy time, we know, as we approach 30 June, so we appreciate you taking the time to join us today. And we hope these webinars that we do run fairly regularly now are a helpful resource to share with you some must-know information and guidance on different topics that may be of interest, things that we're seeing in our day-to-day practice, and so on. And you can catch up with the recordings and slides for our previous webinars by heading to our website and clicking the link to the resources page. And we'll share some details about that later on. And you'll find webinars from our lawyers on all different areas that we practice in, from commercial law to property law, workplace relations, wills and estates, and litigation. But today we're looking at a relatively recent development in Victoria, which is the introduction of the commercial and industrial property tax, which I'm sure you've all heard about and have some familiarity with, but it is a big change and it is coming in a matter of weeks, of course. So it seems to be that soon that even the SRO seem to be a bit caught on the hop. So we'll share some things to understand about the new tax today and how it will operate in practice, but also some things to keep in mind during these last couple of weeks leading up to the commencement date too. So I'll shortly hand over to Andrea, who will start taking us through today's content. Andrea is a principal in our law practice and an accredited specialist in property law. He's got a wealth of experience, obviously, in all things property, and I know that he and Shubha, our senior associate in the property law team, are looking forward to sharing their knowledge with you today. But before we begin, just a couple of housekeeping items. We are recording the session and it will be available on our website shortly. And as soon as that's ready to go, we'll circulate that around to everybody. And if you have any questions throughout the session, please type away in the Q&A box and we'll try to get through questions as we go, and we've allowed some time at the end. But if we do run out of time, because we are conscious of everybody's time constraints, don't worry, we will get to you afterwards if there's any questions we weren't able to get to before the end of the session. Before we begin, just a little disclaimer, we are lawyers, of course, so there's always some fine print, and needless to say, we can only give you some general guidance in this webinar. Everybody's circumstances are different, so it's really important to keep that in mind when you're thinking about your own situation or that of your clients. And of course, this relates to the law in Victoria. It's a Victorian tax that we're talking about today. So keep those things in mind, and before doing anything or before your clients do anything, feel free to get in touch for some specific advice about your own situation. So without further ado, we'll get things started, and I'll hand over now to Andrea to start taking us through today's agenda. Thanks, Andrea.
Thank you very much, Mitch, and hello to everyone. Just thought I'd start with a bit of an overview of what we're going to cover for today. So I will start off with a bit of an introduction on the commercial industrial property tax, CIPT, for the purposes of today. Otherwise, it's a bit of a mouthful for the whole webinar. So I'll run through those general operation of things. Then we'll run through some practical examples. So Shubha will then go through exemptions to the CIPT, how a normal transaction would work in terms of sales, purchases, timing issues, things you might need to consider now if you're looking at dealing with some property before 1 July. And then also the new government transition loan that will be put in place to help pay for stamp duty after 1 July if a purchaser decides to go down that route and if they're eligible. It'll then switch back to me and I'll run over landholder dealings in terms of transacting within, say, shares within a company or units within a unit trust. And what about land consolidations, subdivisions, if you're in the development space, changes of use, given, as I've noted, it's a commercial industrial property tax and doesn't cover any other areas. So if there is suddenly a change of use to one of those non-qualifying areas, what's to happen? What about leases? Does it have any effect on that? And then hopefully a little bit of time for questions there at the end. So I'll kick straight into the introduction. If we can move on to the next slide. So in short, the CIPT is a new tax. It will apply to commercial industrial properties. It will be assessed at 1% of the site value of the land. And it will basically commence in terms of properties that are transacted on or after 1 July 2024. It is basically the government's transition out of stamp duty. If everyone can recall when GST was introduced in 2000, the part of the philosophical idea of that was that transactional charges like stamp duty would eventually go. Taken a little bit of time, but the government has now, at least with commercial industrial property, found a way to get that to happen. So from the government's perspective, it's really a transition out of a bit of a lumpy revenue base in terms of stamp duty coming in, very dependent on transactions happening, of course, and assessed against the value of those transactions, to an ongoing annualized tax in addition to the land tax, and the government then securing its tax base that way. This will apply to commercial industrial property. Now, how is that defined? It all links back to the Australian Valuation of Property Classification Code, AVPCC. All of these acronyms will end up being very familiar to everyone as things go along. But basically, those codes that I've listed there on the screen, covering all industrial and commercial uses essentially, is what this new tax will apply to or can apply to. Where do you find that code? You will find that code on your annual council rates notice. As Mitch has said, this has caught everyone a little bit on the hop in terms of on the government side of things, because at the moment, all the standard certificates you would get for a vendor statement in a sale, for example, don't actually list the AVPCC code at all. We're being told by the SRO that the land tax clearance certificate, or the clearance certificate as they call it, will have that AVPCC code put into it shortly. After 1 July, the vendor statements are required to have that in there, so it will be more obvious in terms of if you're going to be buying land that will be subject to this new regime. There is also some thought in terms of mixed uses of land. Sometimes you will have a commercial industrial use with some residential or non-qualifying use as part of that. In that mixed use scenario, it'll come down to a sole or primary use test, and the SRO will have discretion there. So some elements of risk, obviously, when you're talking about SRO discretion, there will be an opportunity to obtain private rulings if need be in those sorts of circumstances. But obviously, there's some pluses and minuses in being in the new regime and not, so that'll be part of the consideration if you are in that mixed use scenario. You do have to be aware that at this point, and we were as a team listening to some more information from the SRO on Friday, in fact, and some of these practical processes and how they're dealing with things on their duties online system, how the transition loans will work on a practical basis, they're not all exactly set yet. There is more information to follow in relation to subdivisions and consolidations. We'll go through what we know so far a little bit later on in the webinar, but there is that element that is still in flux. So there's a little bit of a watch this space here from the SRO in terms of that practical operation side of things. So if we move on to the next slide, what's to happen to stamp duty now? So this is a transition into the new scheme, into this new tax applying. There is going to be one more lot of stamp duty to be paid. So after 1 July, if you enter into a contract on 1 July or any date after, that will bring you into the new scheme. A couple of caveats to that, but in a general sense, once you've gone into the new scheme, there is one more amount of stamp duty to be paid. That can either be paid upfront, which is basically the same process as now, or it can be paid over 10 years via a transition loan that will be managed by the Department of Treasury. And Shubha will run through a bit more detail on that side of things in a little bit. Once you are in the CIPT scheme, no stamp duty will apply on any further sales. So that's the plus side to this. So, in 10 years' time, yes, you will be paying this additional CIPT tax, but there will be no stamp duty in any of those sales. So hopefully from a vendor perspective, a bit more money in your pocket maybe in terms of what's on offer and what purchase has available. From the purchaser side of things, depending on where those funds are allocated, maybe that's a bit more cash flow available for actual operational or other uses. So when is the tax going to be assessed and payable? The CIPT will be a calendar year-based tax, basically the same as land tax. It'll operate on a calendar year basis. The first year that it will be payable will be 10 years, or the first full calendar year, 10 years after the transaction that brings the property into the CIPT scheme. So as a practical example, anything that's contracted now between 1 July and 31 December of this year, they will be paying CIPT in calendar year 2035. So in some respects, a little bit of a way away in terms of that new tax starting to apply. But obviously the practical impact of this will be felt almost immediately. We're already having those discussions with people in terms of considering whether they're contracting pre-1 July or after 1 July because of these impacts. The SR hasn't yet released, and as of Friday, when we were getting some more information from them, they haven't yet worked out when exactly in the year the CIPT will be paid. You would have expected it would have just lined up with land tax, but apparently that is not a given. So that's still yet to be decided, and they have indicated that they're looking towards the earlier part of the year, but as with any government, I'm sure they'd rather have the money in earlier than later, but we shall see. So what's to happen to land tax? Well, that is unchanged. So the CIPT will operate in addition to land tax. Once you enter into the CIPT system, you will be paying both in 10 years' time once the CIPT actually kicks in. So if we move on there to the next slide, and I will hand over to Shubha.
Thank you, Andre. Good morning, everyone. So I'm going to be dealing with what exemptions can apply to the CIPT. So if the property comes into the CIPT regime, then as Andre indicated, on the 11th year, the tax would be payable. However, if at that point in time, the land has exemptions from general land tax, such as primary production land, then the CIPT will actually not be payable at the time. This change of use might be subject to duty, which Andre will be discussing further separately, but that's one exemption. With regards to further duty being payable once the property is entered into the scheme, generally it should just be the one-off, the entry transaction, one lot of stamp duty will payable, and provided the qualifying use stays the same, it stays within those codes that are there. As long as that initial transaction that brought the property into the scheme related to 100% of the land, or where it's less than that, and there are further transactions involving the land, but they sort of happen 3 years after the initial transaction that brought the property in, or if there's a fractional interest again, and the further transactions that deal with the property sort of bring them in, happen within 3 years of the first transaction, then duty that was paid on the initial transaction will not be doubled up and charged again there. So there are some carve-outs as to whether stamp duty will be payable on further sales down the track. Next slide, please. So we thought it would be good to sort of give you some examples on how the actual tax is actually going to work. So on the first example there, so we've got a contract date of 14th June 2024 with a settlement date of 14 August 2024. And the property falls within the qualifying use codes that are there. As the contract is entered into prior to the reform commencing on the 1st of July, this property will not enter into the CIPT scheme. With regards to the second example, similarly, we've got a contract date of the 14th of July and a settlement date of the 14th of September. It relates to a transfer of the full 100% of the property. The property satisfies the qualifying use and the transaction is not duty exempt. However, the contract arises out of an option agreement that was entered into by the parties before the 1st of July 2024. The legislation allows that if there is an agreement or an arrangement that was entered into prior to the 1st of July 2024, which then relates to the transaction of the property, that property will still stay out of the CIPT regime, and it will not be have to follow that regime. With regards to example number 3, again, we've got a contract date of the 14th of July and a settlement of 14th of September. Relates to 100% of the property, and the qualifying use is also ticked off, but the transaction is actually duty exempt. So there's actually there's no actual duty liability that arises. For example, there's a transfer from a deceased estate. So although the contract and settlement are after the reform commences, that property will actually not enter into the CIPT regime. With respect to this next example, so we've got a contract date of the 14th of July and a settlement of 14th of September. 100% of the property is being dealt with here with the qualifying use, and the transaction is not duty exempt. So there is actually an amount of duty that needs to get paid. So what will actually happen here is that on the settlement in 14th of September, the property actually enters into the CIPT regime. On the 10-year anniversary of the initial transaction, which is 14th of September 2034, for that period, as at the 31st of December 2034, the property then gets assessed for CIPT. So in the 2035 year, there will be an assessment from the SRO stipulating the amount of tax that needs to get paid. The taxpayer will then have to pay that amount. As Andrea indicated before, we don't have an understanding yet of what date the SRO will require for payment. And then ongoing from that, as at every 31st of December, the property will then be assessed for the CIPT. Next slide, please, Mitch. It's going the other way. Yep, thank you. Thank you, Rich. So with this next example, we've got a contract date of the 14th of July and settlement date of the 14th of September 2024. It's for a transfer of 40% of the property. Qualified use is ticked, and there's also a duty amount payable here. So although the contract and the settlement date are after the regime commences, because the property part of the property that's being transacted is less than 50%, it actually stays out of the CIPT regime. With example number 6, we've got a contract date of the 14th of July, a settlement of the 14th of September, 70% of the property is being transacted, the qualifying use is ticked, as well as there's a positive duty amount that needs to be paid. So over here, again, on the 14th of September, the property will enter into the scheme because more than 50% of the property is being dealt with. 100% of the property will enter into the scheme. With regards to CIPT, it's either the property is in or out. So although 70% is being dealt with, 100% of the property is going to be entering into the scheme. Duty will be payable on the 70% that's being transacted. At the 10-year mark in 14 September 2034, so the property will then, in that calendar year, be assessed for CIPT as at 31st of December. And then in 2035, the SRO will issue the assessment and payment will be required. And ongoing, every 31st of December, assessments will continue to be made by the SRO and all those assessments will relate to 100% of the property. Next slide, please. So this one, we thought we'd change it up a little bit in terms of if properties are being bought in tranches, so fractional interests over a period of time. So here we've got a property with a qualifying use throughout the period of time that are sold to the same purchaser by way of 3 contracts, and all the transactions attract stamp duty liability. So the first contract is on the 14th of July, with a settlement on the 14th of September, and it relates to 40% of the property. So this first contract will not cause the property to enter into the regime because the property percentage being transacted is not at the 50% mark. The next contract is on the 14th of July 2026 with a settlement date of the 14th of September 2026. This relates to a transfer of another 40% of the property. Now, this second transaction will cause the property to enter into the CIPT regime because now the purchaser has transacted with 80% of the property. So as at the 14th of September 2026, the property will enter into the scheme. So 10 years down the track, on the 14th of December in 2036, the 10-year transition period is completed. And the 31st of December 2036, the property will then be assessed for the CIPT tax for 100%. With the contract that's stated on the 14th of July, with a settlement on the 14th of August, the remaining 20% of the property is transferred there. Because that transfer happens within 3 years of the transfer that brought the property into the regime, which is the point at 7B, duty will actually need to be paid on the transfer of that remaining 20% of the property as well. Next slide, Mitch. So this example is similar to the previous one in terms of the split between the purchasing of the property by different percentages across different times. However, with the last example that's there with the contract date, that particular transaction occurs more than 3 years after the entry of the property into the scheme. So the property will enter into the scheme on the 14th of September 2026, and CIPT will be payable from the date on the 2030, from the assessment year of 2037. With the remaining transaction of 20%, this will not incur duty as it's more than 3 years since the entry of the property there. We will preface that to say that the commissioner does have discretion to sort of aggregate these sorts of changes if he believes that it's being undertaken for tax avoidance purposes. So if there are genuine transactions here, then that last 20% transfer will not incur any stamp duty there. But CIPT will be payable from the 2037. Now, as Andrea mentioned, the amount of the last stamp duty payable can be subject to either being paid as a lump sum in full or by way of a government transition loan. The transition loan is administered by the Treasury Corporation of Victoria, or they can actually outsource the administration of that as well, but TCV will remain ultimately responsible for the administration of the loan. So the key aspects I'm going to talk about, the first one would be what is an eligible property or transaction. So that would be any transaction that brings the property into the CIPT regime. However, it does exclude dutiable events that arise from landholder duty, economic entitlements duty, long-term leases, and also changes in beneficial interest that are there. Next slide, please. Another big part of this would be whether the actual purchaser who is dealing with the properties is actually an eligible applicant. It can be a business as well. Companies, trustees, and partnerships are also eligible for the loan, and individuals as well. So with individuals, they have to be over 18 years old at settlement, and they must either be Australian citizens or permanent residents. The property must not be used for any predominantly any personal, domestic, or household purposes. And a key criteria is that the property must have received finance pre-approval from an authorized deposit-taking institute or an APRA-registered financial corporation which has an Australian credit license. So this is sort of a key area. If there is actually no finance, if it's a cash purchase, then there will actually be no eligibility to actually obtain the government loan. An applicant must also not have engaged in prohibited activities. The list of prohibited activities is quite long, but it's basically anything that is illegal under Australian law, includes labour hire licensing, other state and federal industrial relations law, equal opportunity, anti-discrimination, any affirmative action legislation. It also includes the usual, if the property, if the applicant's been placed under external administration or bankruptcy petition has been issued. If it's a company, whether it's become deregistered, or if there's particular registrations and permits that are required to be held by them and those have ceased. And also if the applicant's been subject to any adverse findings by a federal or state government agency or local council regarding their business activities or operations. So if this does apply to any applicant, then they won't be eligible for the loan. The loan does specifically exclude SMSFs and foreign purchases. So stamp duty for those entities will need to be paid as a lump sum upfront. So in terms of the TCV granting the loan, they do have to carry out a sort of a credit assessment process on the applicant entity. All documents that have been provided to a lender to apply the loans for the purchase price will need to be provided to TCV as well. TCV has the obligation to check that the property is an eligible property, so it's an eligible transaction. The applicant does have to confirm to TCV that it has legal capacity and authority to enter into the loan and to provide the security, provide the property by way of security. The applicant has to attest to TCV that it is an eligible applicant and that it has not engaged in any prohibited activities, and that all the information that it provides to TCV is true and accurate. So in a way, that self-attestation is what TCV will be relying on in terms of granting the loan. If the applicant, and also TCV do have the ability to undertake audits to ensure ongoing compliance by the applicant. So during the loan term as well, they can conduct these audits. So just the fact that the loan gets granted doesn't mean that it will stay that way for the period of the whole 10 years. If the applicant does default on the loan with a lender, TCV must be notified and TCV must reassess the applicant's ability at that point, whether the loan can actually be continued to be serviced by the applicant or not. In terms of the loan conditions there, they are the same for all applicants. So there's no ability to negotiate any of the terms and conditions. The amount to be borrowed cannot exceed the duty that's payable under the transaction there. Also, the type of loan is a principal and interest facility, with the interest being amortized over the loan term. The duration is that there is a maximum loan term of 10 years from the settlement date, and it cannot be extended as there's not supposed to be any overlap with the CIPT charge on the property. The interest rate will be the same for all applicants. It will be determined at the start of the loan and will not change unless there is a default by the applicant, where then the default interest rate will apply. The interest rate will be based on the base rate, which is the TCV's yield curve. So that base rate will change from time to time as published on the TCV's website. Plus, also, there is a financial accommodation levy margin. This is published by the Treasurer, and the current year, for the current financial year, 1 July 2024 to 30 June 2025, this has been determined to be 2.25%. Repayments are to be made annually. So we don't have a date on when the repayments will be renewed. It will probably be required. It might be on the date of the first anniversary, on the anniversary of commencement of the loan, and so on. With regards to prepayments are allowed to be made as well. These are capped at the amount of $10,000. So any prepayment may also incur a break cost fee. And if paid in part, then the remaining repayments will need to be recalculated as well by the TCV. The loan can be repaid as well, will be required to be repaid if there is a sale or transfer of the ownership of the property. So at that point, the vendor at that point will then need to repay the whole loan. If the property then ceases to be an eligible property, if the borrower ceases to be an eligible applicant, or if a prohibited activity is entered into, or if there's a default by the applicant and they fail to make payment when it's due. There's also TCV has discretion on if it believes on reasonable grounds that the borrower has breached a law, then they can call for the loan to be paid in full. The usual default events of insolvency and bankruptcy and adverse findings are included in here as well. So the loan will need to be paid up at that point. If there is a subdivision or consolidation of the property, this will trigger the loan repayment if the property is then sold to a third party. There are notification requirements in terms of if there's a default by the applicant on its loan with the other lender. So that's a self one where you actually do need to notify the TCV. If there are multiple owners, then they will enter into the loan jointly and be responsible for the full amount of the loan. The RCV does have a hardship policy. So if at any time there are any issues with respect to repayment, you can seek to recourse through the hardship policy that the TCV actually has. Also, the loan is, in terms of the amount of the loan, it's capped at a sale price of 30 million, which with a duty that's payable of about 1.93 million. So if the transaction does exceed that amount, there is not the ability to obtain a loan, and a lump sum will just need to be paid at that point. I will now hand you over to Andre.
Thank you very much, Shubha. So I thought I'd run through a bit of a more complex dealing and slightly more extended scenario that might not be uncommon within a land development context. So I'll start off with concept of landholder dealings. So this is a situation where, say, a company or a trust owns a bit of land. If that land is over $1 million in unencumbered value, then under the current system, stamp duty would apply if a person were to make a significant acquisition, so say buy shares in or units in unit trust, if they were to make a significant acquisition in that entity. So threshold is 20% or more of a unit trust, 50% or more of a company, 90% or more of a public company. There's also a control test to people that are trying to stay underneath those percentage levels, but are actually gaining control of the board of these entities and therefore gaining control of the land. And there's an aggregation provision, generally basically looking back over a 3-year period so that stamp duty can be clawed back on, say, piecemeal acquisitions of a unit trust that actually end up over that 20% or over the 50% if it's a company. That's the present stamp duty situation with those. Now, what's to happen with this CIPT? Because CIPT is also now wanting to capture effectively these land dealings that are being done via acquisitions of shares in companies. So the CIPT just sets one threshold level, which is 50%. So if you end up with 50% more of landholding entity, and that's transacted after 1 July, then the whole property moves into the CIPT scheme at that point. There is a look back over 3 years in order to bring that together. And then obviously there's some anti-avoidance provisions in case there are existing holdings, and it's a little bit over the 3 years, as you would expect. The SRO will have a bit of a closer look at that. If there are post-scheme dealings and some duty paid, there's some reductions available for duty payable on the remaining component. But I think the easiest way to run through all of this would be through a bit of an example. So if we run through to the next slide. So let's say you've got a company called Example Proprietary Limited. It owns Industrial Acre A, and person A decides to buy 20% of the shares on the 30th of June. Now that, because it's a company, 20% under the duty threshold, so they buy the 20% of shares, they don't have to pay stamp duty, but that sets a marker in terms of the date. It's 30 June, so nothing changes really. There's no application of the CIPT because it's under 20%, it's under 50%, and no stamp duty, as I said. A couple of years later, 30 June 2026, they decide to buy more. So they buy 50% of the shares now. And at that point, because the total dealing in shares now exceeds that significant acquisition threshold, there is stamp duty to be paid, and there's aggregation because it was within the past 3 years. So stamp duty will now be payable on the 70% that person A has acquired over that 2-year span, basically. And that will be based on the market value at each of the relevant points in time, but stamp duty will be paid. And in addition to that, as and from 30 June 2026, the land now enters into the CIPT scheme as a whole. The other owner in the land, person B, they've held their 30% there since 2020, and they've basically just been unchanged, silent partner, or a farmer who'd just been waiting for the industrial land to get developed, whilst person A was working through their bits as a bit of a land bank transaction, any number of scenarios, but they've just sat there with their 30%. They're not really affected by any of this. Person A is the one who's had to pay stamp duty. They've entered into the scheme, though, now from 30 June 2026. So from person B's perspective, and not through his or her choice, they are now part of the CIPT scheme. So 10 years down the track, there will be a CIPT liability across the whole of the land. So if we now move over to the next slide. So what if then Example Proprietary Limited decides to sell the land to Pitcher Proprietary Limited a few years later down the track again on the 30th of June of 2029? Now, this is the application of what I was saying in terms of reductions in stamp duty where stamp duty has been paid on entry into the property into the CIPT scheme. So Purchaser Proprietary Limited, buying land that is now part of the CIPT scheme and in a normal sense would have expected not to pay any stamp duty at all, actually will still have a little bit of stamp duty to pay in this scenario. They will have that discounted because person A had paid stamp duty for equivalent of 70% of the company, so 70% of the property in effect, to bring it into the CIPT scheme. Purchaser Proprietary Limited will only have to pay 30% of the stamp duty they would have otherwise paid on Industrial Acre A. So they're getting that little bit of discounting. It is in the scheme, but the stamp duty is still applying, so there is that consideration there. So now, from Purchaser Proprietary Limited's perspective, the CIPT, though, will apply, so the new tax will start to kick in from 1 January of 2037. So that's even though they bought in 2029, and if they were buying pre-CIPT scheme land, they wouldn't have expected to be in the scheme for another 10 years, so not until 2039. Because person A's dealings in Example Proprietary Limited brought the land into the CIPT scheme in 2026, then the actual new tax kicks in 2037. So a little bit of digging then will be part of the due diligence aspect if you're buying these bits of land that are in the CIPT scheme. Moving on to the next slide. So what about consolidations then? Because Purchaser Proprietary Limited, having bought the land, is looking to develop it. They already held a block next door, and they are joining them together, wanting to subdivide it. As a part of that process, they're consolidating it. As we said, Industrial Acre A is in the CIPT scheme when Purchaser Proprietary Limited bought it, so it has that characteristic. Industrial Acre B that Purchaser Proprietary Limited already held, excuse me, that is pre-CIPT land because it's been held since 2019. When it's consolidated or deemed consolidated, and I'll speak about that in a second, both industrial acre A and industrial acre B are now considered to be part of the CIPT scheme. Noting that when industrial acre B joins the scheme, that is not a subject to stamp duty event or anything like that. It's just part of the consolidation. It enters into the scheme. It just changes that characteristic. So if we move on to consolidation 2 example, the reverse is also true, which is an interesting thing in terms of the stamp duty aspect of this. So if industrial acre B was actually bigger than industrial acre A, so more than 50% of the total consolidated land, then the total land will gain the characterization of the bigger bit of land. So industrial A then falls out of the CIPT scheme when it's consolidated with industrial acre B. So that is one way that you can fall out of the scheme separate to a change of use, which I'll go through in a bit. Note that when you're doing subdivisions of land in one registered plan of subdivision, even though those multiple lots that you're dealing with may not be formally consolidated on the land titles register, it will be deemed to be a consolidation that is within the legislation. So any of those large block subdivisions where you're mixing titles together, that's going to be a deemed consolidation, and this will operate. So what's the practical effect of this with industrial acre A and B being then subdivided in that development? Well, the subdivided lot will have the CIPT characterization of the parent lot. So if in the consolidation 1 example, both blocks had been brought into the CIPT scheme via that consolidation or deemed consolidation, then the individual subdivided lot that you're selling out of that development will actually be CIPT land, even if the block that you're actually selling might be sitting in the industrial acre B part of the original property and wouldn't have been CIPT land originally. Because the consolidation deemed it as part of the scheme, that subdivided lot is now part of the scheme and is being sold with no stamp duty to apply because it is within the scheme. The vice versa is obviously to apply with consolidation 2. All of the lots will be non-CIPT lots. So in this sort of scenario, bits of land can be transacted into the scheme without stamp duty applying, which is an interesting side effect of the way the legislation operates, because the subdivision consolidation does not by itself trigger any kind of stamp duty ramifications. So within these examples, where industrial acre B had entered into that consolidated block and then been on-sold as subdivided lots on-sold as CIPT land, there is effectively a missing amount of stamp duty that the SRO would have normally expected. Now, that seems to be a side effect of the way the legislation is operating on its face. The SRO, just as a general warning, the SRO did note on Friday when they were speaking to a bunch of us that the information on consolidations and subdivisions are still being worked on within the SRO and will be further published on their website. So I don't know if they're going to put a different spin on some of these aspects to try and address what could be a gap, but we shall see. So moving on to the next slide. What about a change of use scenario? So in this situation, you bought land that's in the scheme, say, you bought a warehouse, it's within the right AVPC code, but you were going to redevelop them into residential apartments. Obviously, there's a rezoning as part of that, and so possibly a rezoning as part of that. Could be in a broader mixed-use zone. But within the context of that happening and planning approvals, etc., the AVPC code or classification changes to a non-qualifying use. What is to happen then? Now, because that acquisition or the last dealings with the land were basically stamp duty free because they were in the CIPT scheme, the government isn't going to let you get away with that, and they would like to collect their stamp duty then in that scenario. So the way they're going to do that is at the point of change, there will be a change of use stamp duty that will apply, or a change of use that will apply. The concession they will give you, though, is that there will be a 10% discount on the amount of duty that's calculated for each 31 December that's passed since the last duty-free CIPT transaction. So in short, if you've held that land for more than 10 years or 1031 Decembers, by the time the change of use happens, effectively there is no duty in that scenario. However, in a developer's context, if you've gone off and you've bought this warehouse and gone ahead and changed its use, you will get some discounting for the period of time that you've held it, but as you move forward and it's changed use, you will have to make sure you've got funds available to pay that stamp duty or portion of stamp duty that will be payable at that point. The reverse is, of course, given it's tax after all, the reverse is not true. The SRO will not give you a refund of stamp duty paid for non-qualifying land that then converts into qualifying land. So usual sort of scenario. So what if it's, say, a mixed use conversion? So you've turned these warehouses into, say, some shops and some residential apartments. What's to happen there? Because obviously the shops, or maybe not so obviously, but the shops in that situation are still a commercial industrial use. They will still have the right AVPC codes. So in that scenario, those blocks can stay within the scheme, but obviously the residential apartments fall out of the scheme. The new legislation will proportionalize the applicable stamp duty there in addition to the discounting that's applicable as well. So we'll move forward there to, well, what's to happen with leases. The CIPT, as we've been saying, is an additional tax. It is in the vein of land tax, but not in the same context as stamp duty. So the CIPT legislation itself specifically states that it's not claimable from a retail tenant or from a residential tenant. So the Retail Leases Act has been amended for that purpose. And that's just the same as land tax. So the Retail Leases Act, as many of you may know, prevents landlords from claiming land tax from retail tenants. The CIPT is being put roughly into the same part of the legislation to prevent that from happening. The Act is otherwise silent in terms of CIPT being claimable from tenants. Now, by effect or implication then, CIPT, because it's an ongoing holding tax relating to the land, should be able to be claimed from tenants. But just be aware that that's not in any of the standard commercial leases at this point in time. Neither the LIV lease nor the REIV lease have anything specifically to CIPT, of course, because it's a new tax. Although there could be arguments to state that some of the catch-all outgoings provisions relating to overall taxes might capture CIPT. To avoid any of those arguments, it would obviously be a good idea to start amending leases to incorporate claims for CIPT. There are, just as a general comment, there are standard clauses in the LIV and REIV lease to claim back land tax. So it wouldn't hurt to add an additional provision to now add in the CIPT as part of those reimbursable outgoings. Obviously, it doesn't have any immediate effect in terms of negotiations back and forth on new leases now, because it doesn't kick in terms of the first assessment year for at least 10 years from that first dealing after 1 July. But given that leases have a very long lifetime, not only in terms of possibly their first fixed term, but because of the operation of option terms, and because option terms carry forward the original conditions of the lease, it would be helpful, and that way no one forgets in 10 years plus time to have that reimbursable right. Obviously, the reverse is so if you are the tenant and maybe wanting to make sure that CIPT is not funded by you in that sort of scenario. So we'll move on to the next slide there. So what are the key takeaways from today? Not only in terms of the taxes operation, but if you're actually looking at land or dealings in commercial industrial land right now, looking at 30 June, basically 2 weeks away, right around the corner, 1 July, obviously, and the new tax system kicking in after that. If you don't want to be in the CIPT system, if your intent is to buy land, you're going to have a long-term hold more than that 10-year period, you don't want to be paying this annualized tax, well, your only choice really is to contract by 30 June or to enter into options or arrangements by 30 June that give you an entitlement to the land. I would caution in terms of those options and arrangements that at the moment the SRO is keeping to itself a lot of discretion as to what's going to qualify and what isn't. But practically speaking, especially for those looking at a long-term hold sort of scenario, you will want to be signing up sooner rather than later. And for those of you who are commercial agents on this webinar, that might be something you might be mentioning to purchasers just so they are aware in terms of the practical timeframes that are in operation there. After 1 July, you've got to be aware if you're buying pre-scheme or post-scheme land and how that affects your intentions on the property. If you're dealing with multiple sites, what are the different characterizations, effects, and consolidation and subdivision? In terms of a developer, for example, if you're buying land that's going to be entering into the scheme, you will have possibly an advantage, I guess, in relatively inverted commas, of maybe selling those subdivided lots without stamp duty applying to them, whether that's a plus or a minus. I mean, obviously, that's more of an agent's opinion in terms of values, but that's something to consider, again, in terms of whether you're contracting 30 June or 1 July, the 1 day difference being all the difference within this context. So there's really that sort of consideration right now. And ideally, we would have a little bit more detail from the SRO about consolidations and subdivisions, but we will certainly be watching this space and continuing to publish more information on it as it comes out. And then as Shubha has spoken about earlier, if you are buying post 1 July, you also have to weigh up whether you want to enter into that government transition loan or not, because you are tying yourself into that 10-year scheme, paying that stamp duty off with the interest over that time. And although that's freeing up some capital for you, the interest rate that's applicable is effectively a market rate with that 2% risk margin plus the TCV. It's a 10-year Treasury bond rate. It ends up at a rate a bit over 7.2, I think, Shubha. You might clarify that a bit later if you'd like. But yeah, it's not exactly a small rate or a CPI tracking. It is a relatively market rate. So that's something to consider about whether you want to be in that scheme or not. And also flagging the fact that if you're in that scheme and you're paying off your stamp duty over the 10 years, if you happen to sell over the 10 years, you will need to pay the balance of that stamp duty, including the interest, because there will be break fees. You will be having to pay that out at the point of the sale. So that's just a part of the pluses and minuses to consider if you're working through that. So those are the key takeaways. I'm not sure if there's any questions there, Mitch. So hopefully we've been helpful in terms of the information that's out there on this now. And there's certainly, as I said, immediate considerations on it all. So I might just hand back to you there, Mitch, and we'll see if anyone's got any questions.
Thanks very much, Andre, and Shubha too, for all the detail. As everyone can agree, I'm sure it's very technical and unfamiliar in a lot of ways as well. So important to be dotting the I's and crossing the T's and stepping through it very carefully post 1 July. We don't have any questions yet, but so I'll give everyone a minute. If you do want to type any into the Q&A function, feel free. And while we're giving you a moment on that, just a reminder, if you do want to come back and have a look at this webinar again, it will be on our website shortly. There's some examples there of some other property related webinars that we've done over the last little while, and also our lawyers in the property team are constantly publishing articles and updates which will go onto our website from time to time, and we also push out through our LinkedIn and Facebook. So if you want to keep up to date with those as they come, jump onto LinkedIn and Facebook and follow our Sharrock Pitman Legal page there. One question has just come through, Andre. If a property is contracted on the 10th of July 2024 and settles on the 10th of July 2024, does the CIPT 10-year anniversary start from the contract date or settlement? Either July 24 or 35. So there might be a typo in the question. I'm not sure. Maybe it's referring to a settlement a year later. Sorry. Yeah.
Yes, the settlement a year later. So the short answer is it anchors onto the contract date. So those, in terms of extended contracts, which are not unusual in a development context, everything is anchored across anchored on the contract date itself. As a similar sort of fact situation, as I'd given in my example with with landholder dealings, it does go back to when that the earliest possible transaction that brings you into the scheme, the contract for that, that's when things will apply. And also linking that through to arrangements that are pre-1 July. If you sign an option, in fact, it could be a very loose and non-binding sort of arrangement, or warning that the SRO obviously has anti-avoidance provisions in place. But even a general agreement on the acquisition of land could be enough as an arrangement to keep the land pre-CIPT if that is the intent.
Yep.
A couple more questions
A couple
there.
more just come in, then we might need to wrap it up after these two. Thanks, everyone. If a property is currently owned and doesn't change hands for 20 years, i.e. 2024, will that be exempt from CIPT until it's transacted, or will it kick in 2034? And actually the next question,
Yep.
similar vein, if a purchase is in 2030, is stamp duty still applicable with the CIPT starting 2040?
Yep. Yeah, so the answer to the first question is the land that is not dealt with after 1 July, so it's just passively there, it will be out of the scheme. You'll just be paying land tax. There will be no CIPT. It's out of the scheme. When you deal with it in 2044, at that point, stamp duty will be paid, which effectively answers the second part of the question. The second question. When you deal with it at that time in 2044, stamp duty will be paid at that time, and then there will be a 10-year period in that transition into the scheme, so that the first year you're paying the CIPT is 2054. Now, I say all of that within the context that that's the way the legislation is drafted at the moment. You would expect possibly that the government at some point in time might bite the bullet and try and bring everything into the scheme in one go. But that will, of course, have a substantial revenue impact if no stamp duty is being collected within the course of that bringing everybody in. Because otherwise, this legislation, in the way it's currently written, it will take a very, very, very long time for all industrial commercial property to end up in the scheme.
And plenty of elections.
Yeah, so the next question in terms...
Now.
Yeah, so in terms of the factories to be further developed and then sold into next year, if we're dealing with land that is pre-CIPT scheme land, the subdivision itself means the subdivided lots retains the original characterization, so it's still pre-CIPT land after. But what it will happen then is when those subdivided lots are sold, that person, the buyer there, will pay that last amount of stamp duty, and it'll be that sale transaction, that purchase, that post 1 July, that will bring that factory into the CIPT scheme. And then the 10 years will start, the clock will start running at that point. So no effect on the vendor, basically, the developer at that point subdividing the block, etc. But the person buying it will know that they're buying it, paying the stamp duty, and then 10 years after that will be paying the CIPT.
A couple of very quick final ones have just come through, Andre, before we wrap up.
Sure.
If you've got time.
Yep.
If you've got any more questions, everyone, we will put up contact details again shortly, and feel free to contact Andre and Shubha if we run out of time. If 14 factories are being built...
I'd answered that one.
And if a contract of sale is signed in May 24, 30 May, and settles in 30 October 25, and the purchaser and the vendor agree to re-sign the contracts to be dated 10th of July with the same settlement date, will this be eligible for CIPT? So contract was July, but being re-signed after July, but same settlement date.
So I happened to actually be discussing that exact same point with an agent yesterday. It is something to be careful about in terms of terminating contracts, re-entering into new contracts afterward, because that won't necessarily qualify for a scheme an arrangement that is pre-1 July 2024. The SRO could well interpret that as two separate contracts, especially if we're talking about multi-lot subdivision and blocks maybe get renumbered, they move around, might be the same size, but it's a little bit more to the west or north or wherever of the original block. Is it really the same contract? So in that sort of scenario, especially if the buyer is looking at it as a long-term hold, they don't want to be in the CIPT scheme, it will certainly be a situation where they're going to want to preserve the 30 May contract so that they preserve that pre-CIPT characterization and not sign off on a new contract in July, which will bring that question into effect. Or if you really need to change the contract for some reason or other, then you would be looking at trying to have a further deed or agreement in place to record the fact that there was a pre-1 July arrangement for the block. Hopefully it's relatively the same. And giving yourself an argument to say that this was a pre-1 July arrangement that is now being contracted post-1 July in order to keep that pre-CIPT scheme characterization.
And maybe get some good advice before doing anything.
Definitely will need that.
All right. Thanks, everyone. Thanks, Andrea and Shubha, for all of your guidance and knowledge today. And thanks, everyone, for attending and for your really interesting questions as well. I've put up Andrea and Shubha's contact details there. So jot them down, or you can also, of course, find that anytime on our website too. So we'll leave things there for the time being. Good luck as you embark on this new regime come 1st of July. And we'll see you again next time. In the meantime, have a great rest of the day. Thank you.
Thank you.